In this training video, I'm going to teach you how to make a seller finance offer in REIPro to the seller. So as we go up to step one, again, we have our after repaired value. This was calculated with our comparable sales tool and carried over. Now, the first thing that we want to do is to be able to set the price that we're actually going to pay the seller. Now, generally, I can keep this price less than a lease option offer price because I know that the seller is going to receive interest from me, which ultimately is going to make more money by doing it this way. So in this example, I'm going to put $250,000. Now, although the property is worth $307, obviously there could be some maintenance costs, repair items, just getting the house in tip-top shape and so forth, just to get somebody else in this property. Now, when I sell or finance this home, I'm going to own it. Okay? It's not like a lease option where you're just leasing it with the option to buy. I'm actually going to get the deed. It's irrelevant if the owner has a current mortgage on the property, you could still sell or finance it. If they do have a mortgage on the property, it could adjust your number depending on where their payments are, where their loan balance is. So obviously, we would like to get that information, but keep in mind, you still have to craft an offer that makes sense for you, regardless of what the seller has going on over here. Next is the down payment. Again, this will be credited to the purchase price. Now, generally, the down payment is going to be higher than a lease option down payment. But of course, you as the buyer, you want to go in as low as possible because the sellers want as much as possible. In this example, I'm going to put $10,000. Next, we have to determine what the interest rate is. So the purchase price minus the down payment, then amortized with the interest rate, is going to determine what the monthly payment is or what that principal interest payment's going to be. Now, again, I want to start as low as I can, right? Where the seller may need a higher interest, but always start somewhere because you can always come back and adjust these numbers. I'm going to enter 5% as an example. So the next one is loan amortization. So what is the length of time used to calculate this monthly payment? Now, traditional mortgage, when you go to the bank, it's generally 30 years. And that's going to keep that monthly payment down as low as possible. And of course, that's what we would want. So I'm going to put in the number of years as 30. Next is our loan term in balloons because a lot of sellers, they may not want to wait 30 years to receive all their money. So if we click on the info here, the length of time you have until you must pay off the loan in full. So as an example, although we're amortizing the loan for 30 years, the seller may only give us 5 years to cash them out. So what happens is if I put in 5-year term here, my loan's being amortized over 30, but before 5 years is up, if we go all 60 months here, 5 years, whatever the balance owed on the property, I would need to pay the seller in full. Generally, what people do is this is where they would refinance the property to pay the original owner off and create a new loan on that. A lot of times you could actually refinance it for a little bit more than what you owe the seller, which would be a lot of tax-free money coming your way. Next is if you're going to apply any additional principal payments, also the property taxes. So you can find this in step 1. So the property taxes for this property is $3,500. Now we're going to put in the insurance, which I know is $1,200. Now, if there's monthly HOA dues, you would obviously need to enter that there. In this particular case, there isn't. So now when I go up to the summary, it's going to really break down everything. So we have the after repaired value. We have the sales price, what we're going to pay the seller, $10,000 down, 5% interest. We're going to amortize the loan over 30 years to keep that monthly payment down. You're going to do the term of the loan, which we call balloon payment, for 5 years. Our monthly principal interest payment is going to be $1,288.37. So the total loan payment is going to be $1,288.37. Now keep in mind, you also have taxes, insurance, depending on, how this is going to be paid. Sometimes it's paid within the loan that's originally already in place if the seller has one, and sometimes it's not, and that could be paid separately. At the end of the day, you really need to look at the total monthly expense because you own the property now, so you have to pay the mortgage, you have to pay the principal interest payment plus the taxes and insurance. So that brings it up to $1,680. Now the loan balance after 5 years is going to be $220. Total principal payments for 5 years is $19,200. Total interest paid is for 5 years is almost 58,000. So I want you to keep in mind and just think about it this way. Let's assume for a second the seller has no loan on it. Okay, so they're just making all this money. So they've made almost an additional 58,000 just in interest. That's why it's one of the most profitable real estate strategies there is. So as you can see, total paid to the seller over the course of 5 years was 307, which is funny. It's right where it's worth, even though we paid 250. Now you can always see the payment breakdown by clicking the amortization schedule right here, all the way how much principal, how much interest every single month, all broken down for you. Now, once I save this, I can now view, print, or I can email this particular offer. Obviously, any kind of offer that you have, you always want to put it on paper, but you want to talk to the person as well. Either be in person or over the phone. You need to explain a lot of pieces to this. So get out there, start making seller finance offers, and I hope this training video helped and look forward to seeing you on the next one.